I'm Dr. Jeff Jones, and this video is related to solutions for Exercise 2 in the Accounting Review booklet. And in Exercise 2, we're looking at making some distinctions on account characteristics. So Exercise 2 asks us, for each account listed below, identify the following. The normal account balance, whether the normal balance for that account is a debit balance or a credit balance. And again, remember that debit means left side and credit means right side. Letter B, whether the account is considered a temporary account or a permanent account. And remember, the difference between temporary and permanent accounts is that temporary accounts are closed in the closing process at the end of the accounting period, whereas permanent accounts are not closed. Then letter C, for permanent accounts that are considered to be assets or liabilities, identify whether the account is generally classified as short-term or long-term. And we can also refer to short-term and long-term using the terms current and non-current. So those terms end up being synonymous. Short-term is synonymous with current, and long-term is synonymous with non-current. And then finally, letter D, the financial statement where the item would be reported. And here we're going to use IS for income statement, BS for balance sheet, and SE for statement of shareholders' equity. And it's important to note that some accounts may be reported on more than one financial statement. All right, and also an important note, before you work this exercise, additional information regarding account characteristics can be found in appendices B through E of the Accounting Review booklet. Okay, so let's take a look at our first group of accounts. So we're asked, again, to provide the normal account balance, whether the account is considered a temporary or permanent account, if it is an asset or liability, whether it is short-term or long-term, and then finally, which financial statements the account generally is reported on. Okay, so let's look at our first account, which is the cash account. Well, cash account is an asset account, and we know that assets have normal debit balances. So the normal balance for cash is a debit. Since cash is an asset, we also know it's reported on the balance sheet, which makes it a permanent account. And then finally, cash is always considered to be a current asset. So this is considered to be a short-term asset or current asset. And finally, as we mentioned, cash is reported on the balance sheet. Okay, our next account is note payable, and we have a note here that says it's due in 10 years. So that should be a key indicator to you immediately that this is going to be something that is a longer-term item, okay? And in this case, it's going to be a longer-term liability. So notes payable is a liability, and we know that the normal balance for any liability is a credit, okay? Because if we think of the accounting equation as assets equals liabilities plus equity, liability is on the right side of that equation, and so therefore it has a credit balance. Since it is reported on the balance sheet, it is also considered to be a permanent account, and as we mentioned already, it's considered to be long-term since it's due in 10 years. And then finally, notes payable would be reported in the liability section on the balance sheet. Okay, our next item is cost of goods sold. Cost of goods sold is basically an expense associated with selling goods out of inventory. And so any expense is always going to have a debit balance. And so the normal balance for cost of goods sold would be a debit balance. Since it is an expense, it is considered to be a temporary account. Okay, the way to kind of remember this is that revenues and expenses are reported on the income statement, and the income statement reflects activity over a period of time. So when that period of time has reached an end, all of the income statement accounts need to be closed, and so they can start with basically zero balances for the next period. So cost of goods sold is a temporary account. The distinction between short and long term does not apply here. And then finally, as we mentioned, cost of goods sold would be reported on the income statement. So our next account is common stock, and common stock is an equity account, And equities have a normal credit balance. So again, equity is on the right-hand side of the accounting equation, and so we know that common stock should have a normal credit or right side balance. Common stock is also considered to be a permanent account because it does get reported on the balance sheet. There is no distinction between short and long term for equity accounts, so that does not apply here. And as we said, common stock would be reported on the balance sheet, but it would also get reported on the statement of shareholders' equity. Okay, treasury stock. The normal balance for treasury stock is a debit. Treasury stock is regarded as a contra equity account. In other words, it is an account that offsets equity, okay? And so the normal balance for a contra account, contra equity account, is going to be a debit. It's considered a permanent account as well because it does get reported in the equity section on the balance sheet. But again, there is no distinction made between short or long term. And finally, treasury stock would get reported as well on the balance sheet and statement of changes in shareholders' equity. Okay, sales revenue. Sales revenue, the normal balance for sales revenue is going to be a credit. Any type of revenue account, the normal balance is always a credit. And it's also going to be a temporary account, okay, because, again, sales revenue is reported on the income statement. The income statement reflects activity over a period of time, and so all of those income statement items would need to be closed out at the end of each accounting period. There is no distinction for revenues between short and long term. And as we mentioned, sales revenue is going to get reported on the income statement. All right, our next account is sales returns. Sales returns is essentially a contra revenue account. Okay, a contra revenue account is one that offsets a regular revenue account. And so sales returns will have a normal balance that is opposite that of a typical revenue account. So in this case, our normal account balance is a debit. It's also considered to be a temporary account. There is no distinction between short and long term with regard to sales returns. And then finally, it's something that would get reported on the income statement. Okay, so our next group of accounts. Our first one up is prepaid expenses that are going to be used within 1 year. So our normal account balance for any prepaid expense, and keep in mind, even though it says expenses, prepaid expenses are an asset account. And so the normal balance for any asset account is going to be a debit. It's going to be considered a permanent account since it is reported on the balance sheet. If it's going to be used within 1 year, this is going to be classified as a short-term asset or a current asset. And then finally, prepaid expenses would be reported on the balance sheet. Salary expense is our next item. Salary expense, like any expense, it's going to be have a normal balance of a debit. It's going to be considered a temporary account. The short, long-term distinction does not apply here. And like any other expense, it's going to get reported on the income statement. Next up is inventory. Inventory is an asset, so it always has a normal debit balance. It's considered a permanent account since it's reported on the balance sheet. Most generally, inventory is reported as a short-term asset because it's expected that inventory would get sold within 1 year or one operating cycle. And then finally, inventory is going to be reported on the balance sheet. Equipment is also an asset, so its normal balance will be a debit. It's considered a permanent account as well. Equipment is generally going to be classified as a long-term asset because equipment is something that's going to provide an economic benefit over multiple accounting periods. And equipment will get reported on the balance sheet. Accumulated depreciation is a contra asset account, and it's a contra account specifically, in this case, to equipment. So the contra account is going to have the opposite normal balance. So in this case, the normal balance for accumulated depreciation related to equipment is going to be a credit balance. It's also going to be a permanent account. Okay, it gets reported on the balance sheet, and the term accumulated should give you a hint to that we would never close out this account. Finally, it's also considered long-term because it's related. It's a contra account to a long-term asset, and it's going to be reported on the balance sheet. Our next account is accounts receivable. Accounts receivable is an asset, so it's going to have a normal debit balance. It's considered a permanent account, and it's going to be a short-term asset, okay, or a current asset. And then finally, accounts receivable would always be reported on the balance sheet. Okay, our final group here, we start out with allowance for doubtful accounts. Allowance for doubtful accounts is essentially a contra asset account that is contra to the account accounts receivable. Okay, so if this is a contra asset account, its normal balance has to be opposite that of an asset. So in this case, the normal balance for allowance for doubtful accounts is a credit balance. It's considered a permanent account. It's generally regarded as a short-term account because it's related or contra to a current asset, in this case accounts receivable. And finally, it's going to get reported on the balance sheet. Next up is land. Land is an asset, so it has a normal debit balance. It's considered a permanent account. Land is generally considered to be a long-term asset. And of special note, land is one of the few assets in which we would never depreciate the asset. So you would never run into a situation in accounting where you would be depreciating land. And then finally, land, of course, since it is an asset, gets reported on the balance sheet. Okay, next up is the dividends account. The dividends account is kind of a unique account. It reflects and keeps track of all of the dividends that are paid within a given accounting period. The normal balance, since dividends essentially come out of equity, they are paid out of equity, the normal balance for a dividend account is going to be opposite that of a normal equity account. So in this case, the normal balance for dividends will be a debit balance. It's going to be considered a temporary account. It is basically one of the only equity components that is considered to be a temporary account. The distinction of short and long term does not apply, and dividends are going to be reported typically on the statement of changes in shareholders' equity. Now, of special note with regard to dividends, in your textbook you may see dividends reported at the bottom of an income statement. That is not being reported as part of the income statement. It is just being presented there in order to avoid having to add in a statement of changes in equity. So dividends would not get reported on the income statement, but in your textbook they are presented there for informational purposes only. All right, so our next account is dividends payable. Dividends payable is a liability account. It reflects dividends that have been promised but have yet to be paid. So like any liability, it has a normal credit balance. It is considered to be a permanent account, and it is generally regarded as short-term. It's reported as a current liability. Finally, dividends payable is going to be reported on the balance sheet. Okay, next up is utilities expense. Utilities expense, like any expense, is its normal balance is going to be a debit balance. It's considered a temporary account. The short and long-term distinction does not apply, and it's reported on the income statement. Okay, finally, we have the account retained earnings. Retained earnings essentially reflects the cumulative profit since the company was founded minus the cumulative dividends paid. Okay, so that's what retained earnings represents. Retained earnings is considered to be an equity account. And like any other equity account, it will have a normal credit balance. It's considered to be a permanent account. There is no distinction between short and long-term retained earnings because it's an equity account, not an asset or liability account. And finally, it would get reported both on the balance sheet and on the statement of changes in shareholders' equity. So this concludes the solutions for Exercise 2, Account Characteristics. In our next video, we'll begin solutions to Exercise 3, which is a comprehensive accounting practice set.